Ladies and gentlemen, welcome to the Q3 FY23 earnings conference call of Healthcare Global Enterprises Limited. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements do not guarantee the future performance of the company, and it may involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. Now I hand over the conference to Dr. B.S. Ajay Kumar, Executive Chairman of Healthcare Global Enterprises Limited. Thank you, and over to you, sir.
Thank you, and good evening and welcome, and a warm welcome to all present on the Q3 FY23 earnings conference for Healthcare Global Enterprise. Today I am joined by Mr. Raj Gore, our Chief Executive Officer, Mr. Srinivas Raghavan, Chief Financial Officer, besides a few members of the HCG senior management team. Here are our operational and financial highlights for the quarter ended December 22. HCG has been not only a cancer destination for clinical services, but also a destination in research and academic excellence. We have been very successful in creating a hub-and-spoke model across the country, and I'm happy to report that we have made long strides in academics and research, where we nearly have 150 students spread across areas.
Audio is breaking from your line, sir. It's unclear.
Okay. Can you hear me now?
Yes, sir.
What to do? Okay, I'll try. So, we have been very successful in creating a hub-and-spoke model across the country, and I'm happy to report that we have made long strides in academics and research, where we have nearly 150 students at present spread across various oncology programs in Bengaluru and nationwide. Recently, we have published the third edition of the dedicated journal named Precision Oncology, talking about the closing gap in cancer care, including one-of-a-kind journal called Antimicrobial Policy in Cancer Management, with our own data, which will help to treat cancer patients with infections the right way for the first time in our own country. We have collaborated with Intuitive to augment the accessibility of new age surgical technology and robotic-assisted surgery across India, including non-metro cities, by now going into installation the 4th generation Da Vinci surgical robot, US-based Intuitive, in Vadodara, Mumbai, Kolkata, to make this technology accessible to a wider population in the country, to further yielding fruitful results with better clinical outcomes. Our Ahmedabad Center, I'm proud to say, has completed 700 robotic surgery. GI and hepatobiliary and thoracic oncology department completed 500 robotic surgery, possibly the highest type of surgery in the country as far as we know. In the academic and research, we are proud to announce that our doctors, Dr. Lohit Reddy and Dr. Kritika from Bangalore, have been named in the prestigious National Cancer Institute of USA as working committee members in the Rad Immune Division. This kind of recognition is taking HCG to newer, higher levels globally. In clinical trials, we have been one of the few in the phase 1 trials, and several other investigator-initiated trials are also ongoing. There are many more studies in the pipeline, go through a lot of iterations under guidance of our solid ethics committee. We have taken a leadership role in genomics-driven tumor boards and profiled complete 500 gene sequencing for over 1,500 patients, which is the largest in the country to best of our knowledge. This has given insights into patient-centric approach, particularly for advanced and recurrent tumors, not only from India, but from Africa and Middle East, making HCG a destination of cancer care. With a wealth of data emerging from cancer genome studies and data lake which we have created, we feel this is just the beginning of our journey in the precision medicine and to win the war on cancer, not only in early stage, but in advanced cases to convert cancer to chronic disease. I now hand over to Raj Gore to take you through the strategic initiatives and financial highlights. Over to you, Raj.
Thank you, Dr. Ajay. A very warm welcome to all the participants on the call. 4th February was the World Cancer Day, and this year's theme was Close the Care Gap. Being an oncology player, I would like to spend a couple of minutes on this important matter. The global burden of cancer is growing steadily. India is no exception to this trend. More people died due to cancer than COVID in last 3 years across the world. In 2020, there were 8 to 9 lakh deaths due to cancer in India. An estimated economic burden in terms of GDP losses is in the range of $11 billion, that is 0.4% of national GDP in 2020. I would like to highlight 4 major gaps in India that we must address. First, awareness and prevention gap. While awareness levels about tobacco-related cancers is high in India, we still need to create awareness about other risk factors such as HPV, alcohol, and obesity, and drive implementation of prevention measures. Number 2, screening and diagnosis gap. Only 1 or less than 1% of India's population is covered under screening programs for major cancer types such as oral cancer, breast, and cervical cancer, and more than 2/3 of cancer patients get diagnosed late at advanced stages of the disease. Number 3, access to treatment gap. Population living in more than 70% districts in India do not have access to comprehensive cancer centers. Of the 480 comprehensive cancer care centers available in the country, about 40% are concentrated in metros and state capitals. We need to add another 570 comprehensive cancer care centers by 2030 to meet the demand. Fourth, outcome gap. Challenge of growing incidences is further intensified due to suboptimal outcomes compared to global counterparts across all major cancer types due to all other gaps. While these gaps and challenges seem daunting, together we can change that by forging alliances, uniting our voices, and taking action. HCG has been a pioneer and the leader in addressing all these gaps with our 21 comprehensive cancer centers, largest in India. With 2/3 of these centers in non-metro locations, we have been making quality cancer care more accessible and affordable in India since our inception. We have not only provided latest technology and treatments available across the world, but also been able to deliver outcomes compared to leading institutions across the world at a fraction of cost as acknowledged in a Harvard Business case study. Coming back to the quarterly performance, we are very happy to report yet another strong financial performance for quarter ended December 2022. We have continued our streak of highest ever revenue for the 8th quarter in a row and highest ever EBITDA for 7 quarters in a row now. Our consolidated revenue for Q3 FY23 stood at 425 crores, growth of 19% year-on-year. Over the last few quarters, we have been regularly informing you about our efforts to drive growth on several fronts, like enhancing our clinical services portfolio, increasing our clinical bandwidth, and our go-to-market initiatives to increase reach online and offline, retail and institutional accounts, domestic and international fronts. We are making encouraging progress on all these fronts, resulting in a steady growth in new patient registrations, higher utilizations across all modalities of treatments across metro and non-metro markets. In our emerging geographies, our priority is to create scale and grow revenue with an objective to improve capacity utilization and create higher visibility for HCG. In this regard, the company continues to make operating investment in engaging quality clinicians and brand building. We have started implementing few modules of our digital platform across key functions of patient services, sales, and marketing successfully. We have recorded highest ever revenue in both digital and international business. On the margin front, we've been able to improve our margin from 17% in FY22 to adjusted EBITDA margin of 19% in Q3. Our efforts during the last 12 months on pricing optimization and cost rationalization have started to yield, and major benefit will flow in FY24. We are confident of maintaining our leadership position in our mature markets and gaining market share and leadership position in our emerging geographies. With this, I hand over to our CFO, Srini, for financial highlights.
Thank you. Good evening to all of you. We have uploaded our Q3 FY23 results and updated investor presentation on the stock exchanges and company's website, and I do hope everybody had an opportunity to go through the same. We are delighted to share that we have been able to grow our revenues ahead of the industry growth due to the trust and brand created for HCG. On the revenue front, our consolidated revenues for Q3 FY23 stood at 424 crores as compared to 358 crores in Q3 FY22, a growth of 19%. Our revenues for 9 months FY23 stood at 1,252 crores, a growth of 21% year over year. Revenue split between HCG and Milan stood at 96% and 4% respectively for Q3 FY23. Revenue growth for HCG stood at 20% year on year, and for Milan stood at negative 1% year over year. As mentioned in slide 8, revenue for the mature centers stood at 306 crores, a growth of 17% year on year basis for Q3 FY23. Revenue from emerging 101.5 crores, a growth of 29% on year over year basis for Q3 FY23. We are delighted to state that our emerging centers are inching towards maturity and are seeing good traction across geographies. I now request your attention to slide number 9, where we have disclosed our operational parameters across our mature network and emerging centers for Q3 FY23. Our company-wide AOR stood at 65.7%, and AOR for mature versus emerging centers stood at 63.2% and 71.9% respectively. Our ARPOB on company level stood at 37,014, and our ARPOB from mature centers stood at rupees 40,154, and for emerging centers stood at 30,057. Across geographies, we have given our revenue breakup in slide number 10. Rajkot grew by 110%, revenue from Jaipur grew by 104%, and Mumbai grew by 28%. Concall Center of Excellence grew by 15% year over year for Q3 FY23. Our Milan businesses is also doing well. Revenue stands at 16.8 crores in Q3 FY23, and new registrations grew by 53%. On the EBITDA front, our consolidated reported EBITDA stood at 75.5 crores as compared to 61.3 crores in Q3 FY22, a growth of 22%. Reported EBITDA for 9 months FY23 stood at 222 crores, a growth of 27% year over year. Adjusted EBITDA for Q3 FY23, that is, after adjusting the one-time value creation cost and adjustment of ESOP expenses, stood at 81 crores as compared to rupees 63.6 crores in Q3 FY23, a growth of 28%. Adjusted EBITDA margins stood at 19.1% as compared to 18% in Q3 FY22, a growth of 156 basis points. Adjusted EBITDA for 9 months FY23 grew by 35.3% year over year, with margins at 19%, a growth in margins of 200 basis points. We have also given bifurcation of our EBITDA across mature and emerging centers, and I would request the participants to view slide number 8 for further details. On PAT, we are delivering positive PAT for the last 4 quarters now. PAT for this quarter stood at 7.45 crores as compared to a loss of 0.3 crores in Q3 FY22. 9 months FY23 PAT stood at 20.9 crores as compared to a loss of 9 crores in 9 months FY22, adjusted for one-time exceptional gains or losses in FY22. Our PAT pre-Ind AS adjustments for Q3 FY23 stood at 11.3 crores as compared to 3.1 crores in Q3 FY22. PAT for 9 months FY23 pre-Ind AS adjusted stood at 31 crores as compared to a profit of 1.6 crores in 9 months FY22. ROCE for matured networks stood at 19.7% annualized for 9 months FY23 as compared to 15.7% in FY22, an improvement of 400 basis points. ROCE before corporate allocations for matured centers stood. ROCE for emerging centers stood at negative 5.3% annualized for 9 months FY23 as compared to negative 8.3% in full year FY22. This is again an improvement of 300 basis points. ROCE before corporate allocations for emerging centers stood at negative 1.4%. Our net debt position, excluding capital leases, as on 31st December stood at rupees 212 crores as compared to 211 crores as on 31st September 2022. Our expansion of existing facilities in Ahmedabad, Phase 2, and Whitefield extension of Bangalore COE is on track. Total planned capex for Ahmedabad is 85 crores, expected date of operations being Q1 FY25, and for Bangalore COE is 25 crores, expected date of operation being Q4 FY24. With this, I would now like to open the floor for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Reminder to the participants, anyone who wishes to ask a question may press star and 1. The first question is from the line of Kaustubh Pawaskar from Sharekhan by BNP Paribas. Please go ahead.
Yeah, good evening, sir. Thanks for giving me the opportunity. Couple of questions. First, ARPOB for this quarter is down. So, any particular reason for this?
So, hi, Kaustubh, Raj here. Look, as I mentioned in my opening remarks, in our emerging centers right now, we are going for volumes, we're going for scale, we're going for higher utilization of our capacity. It's reflected on a very good growth in Rajkot, Jaipur, and across various emerging centers. That's the reason, ARPOB is lower. But if I would like to draw your attention, this is still an improvement over the Q2. So, as we've always stated, first we will go for volumes, and then we will go to improve the fee of the business and go for ARPOB.
Right. My second question is on the consultation fees. So, this has been there for past 2 quarters. So, when should we expect this, or till what time it will continue on your books, to be reflected? Because you are setting it as a one-time expense. So.
Correct. So, this last quarter, Q4 of this financial year, would be the last quarter.
Okay, Q4 of this financial year. And your bed, till last quarter, it was around 1,797 beds. This quarter, it has increased by around 36 beds to 1,833. So, any new, means where this addition has been done, bed additions, 36 beds?
Yeah, so we have just operationalized more beds in Jaipur. These beds were always there. It's as an installed capacity. We've just operationalized them.
Okay. And another question is on your fertility, business part. So there we have been, seeing the revenues at around 16 to 17 crores, and even on registration side, we are not able to understand like whether there would be improvement in terms of operation in that business, or whether the company wants to focus on that part of business. So any thought process on that?
Yeah, so look, I know that Q3 was flat, but if you look at year on year, we have about 9-10% growth. Q3 could be just a matter of seasonality. There have been certain regulatory changes as well, so the whole industry is adjusting to new regulatory requirements. So we feel that going forward, it will continue to grow.
Want to explain that? What is the regulatory? Want to explain? Yeah. Okay, explain. Explain, man. So presently, this government of India has brought a new regulatory act called ART. I think in the state of Karnataka, it has to be reported its form. I think probably in the month of March and April, the board is going to form, and the next level of patients is going to get engaged. That is because 30 to 40% of our donor programs have been held. So going forward, probably in Q1 of FY23-24, we could see the big numbers growth from that perspective.
Okay. Yes. Okay, so this is a temporary thing. Maybe by Q1 things would improve for this business. Q1 FY24.
Yeah.
Okay. Thanks for that.
Getting normalized from Q1.
Okay.
Yeah, thanks.
Thank you, and all the best for future.
Thank you.
Thank you. The next question is from the line of Anil Sareen from Centrum Asset Management. Please go ahead.
Hi, good evening, everybody. Am I audible?
Yes, sir, you're
Yes, hi, Anil.
Hi. So, first of all, good job once again. I would start with a request that if you can postpone the call for the next day post declaration of results, that would give all of us a time to go through the presentation in more detail, and we can ask better questions that way. So if you could consider that for next time, that would be great. The question I had,
we'll take that.
Yeah, sure. The question I had was that
the next day there is. No, we will do next day because last time there was some requests. We do it on the same day. There's conflicts and all. We certainly take your request and see how we can accommodate. Okay.
Sure. Or at least giving a gap of a few hours. As you know, I mean, there is a result season, a lot of results coming, but sometime the quality of questions would improve if we have had time to go through.
Good point. Good point. We'll take it.
Sure. Thank you very much.
Yeah.
The question I had was that there has been a steady improvement on a sequential quarter basis for the last 7 or 8 quarters that I've been seeing. This is perhaps the 9th quarter. So, but on a sequential quarter basis, the EBITDA margin has not improved in any material fashion, unless I'm mistaken. If you can just throw some light on that, because revenue has grown, but the EBITDA margin post adjusting for these one-time costs, I doubt if it has gone up. If I'm inaccurate, you can please point out.
Yeah, so Anil, good question. So one reason is, our one-time expense in our value creation plan. The second reason is we are disproportionately investing in hiring clinical talent and building brand for our emerging centers to drive scale, to drive volumes across those centers. And we are seeing the results of those, efforts in the revenue growth across emerging centers. So that's a upfront investment, to ramp up the utilization going forward to take it to a next level.
Okay. Great. And so post this coming quarter, that would be the last time when you will have this consultancy charges, unless you go for
Absolutely
a new project. So next year, what kind of overall growth can one expect, and what kind of overall EBITDA margins can, including Milan, including all the constituent parts?
Yeah. So, Anil, without the one-time expenses, we are about 19% in the last quarter EBITDA margin. And, we are confident maintaining our growth momentum going forward on a quarterly basis. We usually don't give forward-looking guidance on numbers.
Okay, great. Thank you very much, and all the best.
Thank you. The next question is from the line of Dhara Patwa from Smiths Limited. Please go ahead.
Yeah, thanks for the opportunity. So I had two set of questions. So despite higher occupancy of 72% in the emerging centers and no ARPOB of 30,000, which is flat on the sequential basis, still the EBITDA margins have seen a decline to 7.5% as compared to the average of 10.5% in the previous 2 quarters. So is it the new normal? Should we expect it, or going forward it will increase to 10-12% or let's say 15%? So what should we assume for the emerging centers? Sorry.
So again, we don't give forward-looking guidance on numbers, but as I explained, lot of our growth in emerging center is coming because we've hired clinical talent, we've increased our clinical bandwidth, we are investing disproportionately higher in our sales and marketing activities. As a result, we are seeing revenue growth. It's an upfront investment. The margins will follow. On question of ARPOB, again, initially we would go for scale, we would go for volume. Usually the playbook in hospitals is you fill the hospital first and then you optimize your mix, your payer mix, and that will drive your realization, all, operating performance indicators going forward. So we are following the same playbook, center by center in emerging geographies.
So should we expect at least a 10% plus margin for the emerging centers for going forward? Like at least a direction, like it won't be below 7%, but it will be above, in the range of 10% or something.
Yeah, it will start, moving towards our mature center bucket, slowly.
Thank you. The current participant has left the question queue. We'll move on to the next question from the line of Aditya Khemka from InCred PMS. Please go ahead.
Yeah, hi. Thanks for the opportunity. Hi, Raj. Hi, Dr. Ajay. First question, if you could help us with what is the current EBITDA margin we do, let's say, at our flagship facility in Bangalore?
I think
So go ahead.
The EBITDA margin in Bangalore, you're talking about Center of Excellence.
Yeah, that's right. Yes.
It's about post-Ind AS is about 28%. 27-28% is our EBITDA margin. Yeah.
Right. And this number would not include any corporate overhead, am I right? This would just be the unit economics.
Yeah. It can improve by a couple of basis points, but as you know, we are reaching the top in terms of the EBITDA margin of our Center of Excellence. Okay?
Correct.
It's at a unit level, Aditya.
Yeah, it's at a unit level. It does not include corporate overhead, right?
Yeah.
Right. Okay. So therefore, my question is that, ideally the endeavor of the company would be to move as many units possible closer to the EBITDA margin that we do at our flagship facility over a period of time. Obviously, it can't happen as soon as you open the facility. It takes time to ramp up and mature a facility to get to a EBITDA margin of 25% plus, which would also imply that at a time when a majority of your capacity of your 1,800 odd beds, let's say when 1,500 of those 1,800 beds actually become mature, quote unquote, then at a unit level, ex-corporate head, we should be at a EBITDA margin of 25% plus, minus then the corporate overhead, which I don't know how much it is, but I'm guessing it would be around 5 to 8% of sales. So my question to you is, when do we see that happening? When do we see a lion's share of our beds, let's say more than 80% of our beds, maturing to a level of profitability that we do in our most flagship facility?
Yeah. So, Aditya, analysis, our model, our business model has been able to deliver a mid-20s EBITDA margin in metro markets, non-metro markets when the center becomes mature. So we will, we will drive the performance of individual units to get to that level. We are looking at about 2 years span for the, entire current base to move in that direction.
So as you know, we are at close to, without the one-time charge, we are at 19% already. This is including the corporate cost. So if you kind of take out the corporate cost at a unit level, they are already in the low 20s. So for them to reach 25, it should be doable. And I think we are on track to do that, I can say confidently.
So, sir, at a unit economic level, are we already at 21, 22? Is that what you mean by low 20?
Yeah. At unit economics, we are already at 21, 22 because our 19% includes the corporate cost.
Which is about 2 to 3% is what you imply.
Yeah.
Okay. So I get it. So it is not unreasonable for.
I cannot take you. Aditya, we can, on a lighter note, we can take your assessment of 5%. It is not 5%, but I'm saying on a light.
No, that's awesome. If you're doing it on the leaner organization, it's actually excellent because, I understand hospital business. The flagship facility would actually include a lot of corporate cost, which gets culled out at the unit level. I get that. I get all that. So I understand. So you're at 2 to 3% corporate cost. So which means, Dr. Ajay and Raj, which essentially it means that it is not unreasonable for a shareholder today to believe that in the next 2 to 3 years, you will see 2 to 300 basis point expansion in EBITDA margin. Am I right?
Yes. It's certainly not unreasonable. And we hope, our hope, though we can't guarantee, we can even better that. That is what we will strive for. That is where a lot of effort is going on in terms of operational efficiency and doing. But if all the centers come to mature and we have good efficiency as we are planning and our revenue growth is there with fixed costs remaining and as you said, corporate costs, we should be able to reach that and hopefully even better that.
Oh, that's awesome. That's very good to know. My second question is essentially on the cash flow. So I heard the net debt numbers, and correct me again if I'm wrong, this would be excluding lease liability. I think it is around 210 to 212 crores for the past 2 quarters. Am I right?
Yeah, that's right.
So, Dr. Ajay, where is the free cash flow? I mean, ideally, the net debt number should have gone down given that we have had a very profitable quarter. What are we investing in? And this is coming off after your PAT. So obviously, your investment in manpower, center of excellence, R&D, scientists, all that is this cash flow is after those investments. So where are we making those capital expenditures, which is not helping us reduce our net debt further?
Okay. Point number one, I think debt is largely flat if you see, over the last couple of quarters. But having said that, we have invested in, for revenue generating activities. For example, we have invested about close to 18 crores in solar in our Karnataka center, that's nice. And, which is gifts. That is giving us some savings in our electricity bill. We have also invested in high-end equipment in our Center of Excellence, the EP solution, which we talked about in the last quarter. And we are also investing in robotic surgery. So these are the places where we are investing. And as I mentioned earlier, these are all revenue generating capex, which will kind of give benefits to the business in the future quarters.
I understand that. So could you give me a capital expenditure number for the 9 months this fiscal?
About 96 crores is the capex for 9 months.
96 crores. Okay, then it makes sense. I understand. My last question is on the technology side, so slightly technical. I think Dr. Ajay, you would be the right person to respond. So this Da Vinci robots, that the fourth generation that you said you are acquiring. First of all, this acquisition of these robotic machineries, I am assuming these are on lease and not outright purchases. Am I right?
Yes, we have created a first of a kind model with them. It is not really a lease. It is our model of pay-per-use model, where I think first time Da Vinci is best of our knowledge in this country, where we have, sir, without any minimum guarantee making, there is a more, we share in our revenue and certain fixed amount, and we found that is doable, and that is we can penetrate tier 2, tier 3 cities apart from doing where we expect the volume to grow over the next year or two. So this is the model we are trying it out with the new Da Vinci 3 units we are putting.
Understood. So we are using this Da Vinci model. So the Da Vinci robots, to my understanding, first benefit is obviously cosmetological because the arms are flexible and you can have lesser holes in the body of the patient than, let's say, versus a laparoscopy, right?
Well, the Da Vinci came about a few decades ago because of the precision surgery. We talked about precision radiation, targeted, but surgery was always not precise. Extensive surgery was done. With the Da Vinci unit, what happens is you get that microscopic look, and we use the Da Vinci handles to really do precision where the normal tissue is not hit. The normal tissue doesn't suffer, and it is precise excision of the tumor or whatever your target is. Thereby, the patients recover fast, complications are less. So overall, as you said, the cosmetic scar also will be less. So based on all this, more and more Da Vinci users have come compared to the time when it came for uro-oncology first. For doing prostate was the first time it came. Now we are doing significant, like I said in my opening remark, we have done in Ahmedabad one of the highest removal of the esophagus using Da Vinci. It's a remarkable feat because it is almost in 3 days the patient can go home, literally no pain and no complication. We used to have these, leakages at the anastomotic site. We don't see all that. So it is a near perfect you can reach in terms of surgery, and outcome will also be good and less hit on the normal tissue. And head and neck also we are beginning to do without any scar. Imagine doing head and neck surgery, oral surgery, where there is no scar and good outcome. So we also have signed up an agreement with the Da Vinci where we will be doing not only training, but we together will create some innovative platforms. So that is what personally as a doctor I am looking at. How do we innovate new techniques, new technologies?
Sorry, I have 2 more questions on this platform, Dr. Ajay. Firstly, how many clinicians or how many doctors or surgeons do we have certified by Da Vinci to operate and use the Da Vinci system?
Yeah, today in Bangalore we have about 5 surgeons who are certified, and we have our own training program with Da Vinci. In Ahmedabad, we have another 4 to 5 people who are trained in not only head and neck but GI. And we have others, like one doctor in Cuttack who is already training, waiting for Da Vinci. And we have 2 or 3 trained in Mumbai who are ready to do surgery now. So we have quite a few, and we intend to increase this number, not only for HCG doctors, and we want to make sure even outside doctors can come and train precision, so that essentially the patients at large can benefit. That is what we are looking at. Okay?
That's an awesome objective. Last question on the Da Vinci platform. Intuitive also has this new system or this new sort of a diagnostic machine that helps in diagnosing lung cancer early for the smoking population. Any thoughts on that, Dr. Ajay? Have you explored that option with Intuitive?
No. We have not explored that. We will certainly look into that and explore. We have explored this low level of a CT scan for smoking population. We are thinking of launching that on Sundays, where we can do low CT scan to explore. This is the big trial which was done in US years ago, very successful. So we have been working with the radiology group. We are bringing possibly a new radiologist who's experienced in that. But Da Vinci part, I have not explored. I will certainly look into this.
Yeah, they call it the lung biopsy or something. I think when I studied it, I found it really exciting. So maybe something because it's beneficial.
I know what you're talking about. It's a robotic guided lung biopsy, where there is very minimal intervention. But there are parallel units available, so certainly we'll look at it. But they did come and make a presentation a few months ago. So we are evaluating what's suitable for our people here. Okay?
Makes a lot of sense, Dr. Ajay. Thanks a lot, and more power to you guys to help our country and our society. Thank you.
Thank you. Thank you. Thank you.
Thank you. The next question is from the line of Rishabh Sisodia from Samiksha Capital. Please go ahead.
Sir, audible?
Yeah. Sisodia, the audio is slightly breaking.
Sir, am I audible now?
Yes, please go ahead.
Sir, one question on the growth guidance that we have. So, given that we are reaching, almost 70% occupancy now, and our new bed capacity that you mentioned is coming up by the end of FY24. So, how confident are you for the growth momentum for the company? And at the same time, where do we see our RPOB growth going ahead for both the centers, emerging as well as mature?
Yeah. So thank you for that question. The occupancy numbers we report are on operational beds. If we do, not all the beds in some of the emerging centers have been operationalized. If we take this occupancy on an installed bed capacity, it becomes 56%. So we don't expect bed capacity being a constraint in our growth, especially since, our chemo modality is a daycare modality. Radiation doesn't require bed. It's only the surgical patients who require largely overnight admission on inpatient beds. So we don't see bed being a constraint for us going forward in terms of driving growth. Yeah, I just want to add what Raj said is absolutely right. Just want to say in oncology, historically, it has been more and more outpatient and less hospital stay. As you look at the ALOS, it tends to come down as we move forward year on year. So that is the reason the bed is not the way we feel to measure the growth. There are other parameters we should take into consideration to look at the growth.
Okay, sir, that's helpful. And sir, on the Mumbai center, so the current growth given as compared to other centers like Jaipur, Rajkot, they have very high growth. So why is the Mumbai center having a bit of low growth given we acquired new assets recently?
Yeah, so I think the Mumbai growth looks subdued because last year we had a significant vaccination revenue in our Mumbai center. These were the emerging centers. COVID came, we couldn't go out and build brand HCG among the communities that we serve. Vaccination was a good opportunity to respond to nation's call, as well as reaching out to the community to build our brand. So we drove that very well. If you adjust that, this growth will look better. The other part is in Mumbai we go for a better payer mix compared to Rajkot and Jaipur. So it's more cash TPA corporate driven growth rather than government driven growth. So that's also another reason that this growth will be a better quality business growth, yielding better RPOB eventually and better margins.
Okay, so just a last question. So on an entire company basis for the cancer part, so what would be a payer mix if you could just break it down?
Is it payer mix? About almost 65-70 will be cash plus insurance, and then remaining will be government as well as corporate business.
Okay, so are we facing any repricing issue with the insurance companies or with corporate? And do we see that any further repricing ahead that would help us in the ARPOB growth going ahead?
Sorry, can you repeat your question?
I'm asking, given that insurance corporate parts, are we looking at increasing our rates with them, and that could help our ARPOB next year growth?
Yeah. So, usually this comes for renewal every 2 years. So, it will come up for renewal next year in some of the centers. It's center by center, thing. So, after the contractual period, we go for a rate increase. In general, if you look at historically, we have a larger presence outside big cities, outside metro cities. Many of our new centers, are in bigger cities relatively. 2 in Mumbai, in Kolkata, Nagpur. These are better markets. So as this share of these emerging centers grow as a share of total revenue, our ARPOB will automatically start growing to a higher level.
Okay. Sure, that's it from me. Thank you.
Thank you. The next question is from the line of Urmil Shah from Aegis Federal Life Insurance. Please go ahead.
Yeah, thank you for the opportunity. So my first question is, you mentioned 56% occupancy on installed bed. That's at the company level, or if you could split between mature and emerging centers.
Yeah, so 56% on a total capacity. Yeah.
Sure. So what would be the same number for mature and emerging centers?
So it's like whatever you see on the slide as far as established center or mature center is concerned, there we don't have any difference between operational and capacity beds. It's primarily the new centers where there is a difference of about 250 beds where we have installed 250 beds less in our emerging centers. Thereby, if you take capacity utilization in terms of beds at emerging centers, it is around 56%.
Sure. And from a medium-term perspective, 65%, which is the occupancy for the mature centers, that's what should be doable. Of course, it will be depending on each center, but from a 3-5 year point of view, your current beds should be reaching that kind of occupancy.
Sorry, we missed your question. Is it a debt question or bed question?
Bed. So you mentioned that the occupancy level in your mature centers, it's similar for when calculated on operational beds or installed capacity. My question was, as regards the emerging center, from a next 3 to 5 year point of view, they should also be getting to 65% kind of occupancy level. And where in your case generally, at what kind of occupancy levels you would further need to add capacity in a particular center?
Yeah, so we do expect emerging centers to start reaching to mature center occupancy. Usually around 75%. When the occupancy hits 75%, we start looking at how do we create capacity. See, one of the things you must understand, as I mentioned earlier, that it's only surgical specialty which largely uses overnight inpatient beds. That average length of stay is going down with minimally invasive techniques, robotics. So what we've seen in our experience, what is happening is we are converting inpatient beds into daycare beds. We have on daycare beds, we have ability to increase number of shifts in the same day. For us, bed is not as much a concern as one would think in a multi-specialty environment.
Sure. So my second question was more on the emerging centers. We've discussed about the margin performance over there. What could be the drivers for getting the margins, if not to the mature center levels, but at least, to mid-teens? What could be the drivers, keeping into account the current RPOPs and the AOR which we are currently doing?
Yeah. So, Urmila, as we mentioned, right now we've invested in clinical talent. We're taking them out in our outreach markets. We're investing in branding and marketing sales activities. Basically, driving more new patients, driving utilization of different modalities, driving capacity utilization, driving revenue. That's the short way to improve margin in these centers.
Sure. And just to dissect on the AOR for emerging centers, of course, this is an average. So, does the emerging centers also have a few centers where the AOR would be 75% plus?
Yeah. So yes, like for example, Jaipur, where we just mentioned earlier that we commissioned more beds, because we were reaching higher occupancy. So yes, in that bucket, we do have center which is, a higher capacity, higher occupancy.
Sure. So then in such centers like the Jaipur centers, how different is the profitability as compared to the emerging center category as a whole?
So Jaipur in a span of year has gone to EBITDA margin of mid-20s post-Ind AS.
Sure. Okay. Yeah. Sir, my last point was on the free cash flow question which was there. So this year we are having the investments for new high-end equipment, also in talent, also on the consulting fees which are there. Next year, if we look into, we've already talked about the capex for the capacity addition. So adjusted for the one-timers and the investment which have gone in this year, would it be fair to assume that that's the bare minimum increase in free cash flow on NOPAT that should come in?
Yeah. See, the way to look at it is, we'll have to look at our ratios of, our debt to EBITDA kind of a ratio, which is at a very, very acceptable level as far as the overall business is concerned. So if you see, we are at about 2.3, and we should be around that, maybe slightly come lower as well in the future quarters. But having said that, the key point is there will be some amount of capex. While there won't be any VCP cost next year, there will be some amount of capex towards maintenance capex, growth-oriented capex. Those will be there in the future years as well. But the key point to note is these will not come at any additional extra borrowings. We will be able to manage out of our internal accruals, point number one. And number two, we will be able to maintain some of our key ratios at an acceptable level, which is acceptable to the market.
Sure, sir. Thanks for answering my question and all of that.
Thank you. The next question is from the line of Sagar Shah from Phillip Capital PCG. Please go ahead.
Yeah. Good evening, sir. Actually, I just had one question. We were looking to open our 203 inpatient beds in the time to come. So, can you specify a time that in which something like in 6 months or in 12 months or in the next 18 months are we going to open up the beds? And my second question was related to our growth drivers. For FY24, what would be our key revenue drivers for the same?
Yeah. So, Sagar, the answer to your first question really depends on how it will change from hospital to hospital. But as a total bucket, in next around 18 months, we'll have to deploy all our installed capacity, which is not operational. We have to operationalize it. In terms of revenue growth drivers, look, the growth drivers for next year will continue to be the same growth drivers that have helped us this year also. And just to add on that, the growth drivers, obviously, we are looking at the ones which are not mature. Those which are not mature center will grow faster, obviously, than those who are mature. That could be, and also the technology we are investing, and like what our CFO said, new technology we have brought, those will be also drivers for the future.
So basically, you are saying the improvement in the utilization of the emerging hospitals, improvement in the volumes of the new patient volumes in the emerging hospitals would be the same growth driver for for the company in FY24, right?
Yes.
Okay. Thank you, sir. Thank you so much. All the best.
Thank you.
Thank you.
The next question is from the line of Pallavi Deshpande from Sameeksha Capital. Please go ahead.
Yes, sir. Thank you for taking my question. So just on the part where you have mentioned about adding talent, etc., will we be done with that this year, or will we be will this be a continuous process on the clinical talent side? Just wanted to understand.
Pallavi, I don't think we'll ever stop adding clinical talent. In new centers, you will first make sure that your clinical services portfolio is complete. When those start, growing, their bandwidth starts getting choked, you will add more clinicians under each. As the program evolves, we'll start creating vertical specialization, head and neck, breast, etc. So this is a continuous process. We'll continue to, invest in talent going forward.
And, just to add to that, for us, being a very specialty focused, as you know, where oncology is growing is in multidisciplinary clinic, tumor boards. For this, we definitely not only have to have training the doctors and also add additional talent. And that is what we are doing, not only in big centers, but even in tier 2, tier 3 cities. Our talent pool is increasing and definitely increase, and that will definitely add to our overall growth. And we have proven that again and again.
Yes. Got it. My second question was on the ROC. So on ROC for the emerging centers, we've just seen a small decline quarter on quarter, I guess, not material, but yet, just the direction seems to,
So as Raj said, it is not material, and quarter 3, as Raj said, we have sort of invested more on operating expenses related to clinical talent, hiring, and promotion. This will start resulting into higher revenues going forward. However, it is temporary, as you rightly said.
Okay. And so you mentioned about the mix for the government and corporate at 30. Within that, would it be possible to share, or just pure government? I think just last time I had the number, it was 14%.
So, Pallavi, historically, our presence outside metro cities was larger, where we had a mass market strategy, low price, higher volumes with government schemes. Many of our emerging centers are in bigger cities. We have, for example, we have 2 in Mumbai, 1 in Kolkata. They will have a better payer mix, better price realization. So as share of emerging centers to the total revenue goes up, all these parameters will start improving going northward.
All right, sir. Thank you so much.
Thank you.
Thank you. Ladies and gentlemen, due to time constraint, we will take one last question from the line of Naman Bansali from Perpetuity Ventures. Please go ahead.
Hi, sir. Thank you for the opportunity and continued growth in the business. Just one request was that you used to give in FY22 a good breakup of ARPOB, EBITDA margins, and occupancy on a region-wise basis. It would be great if you could continue giving that in the presentation, if possible. So that was a request. And my first question relates to the international patients. How much of the business as a percentage of contribution was international patients? And what do we do to attract these patients? Are these organically driven, or are we hiring any agencies to attract these patients from international borders? And my second question is on the industry and on HCG, that how is HCG different from a Proton and other hospitals in the industry who also have a high-end oncology machines like CyberKnife and etc. And what risk do this industry in oncology face in terms of newer technologies being introduced in coming future? These are my two questions. Thank you.
So Naman, Raj here. Let me take the first part, and Dr. Ajay will take the second part on the difference between different technologies. So one, will take your suggestion into consideration about the breakup. Second, international business. Look, we drive international business through all channels that are present to us. There are agencies, there are direct institutional tie-ups, there are tie-ups with international insurance agencies, and there is direct business generation, which we do by taking our clinicians, to these cities, to these markets. We have information centers in these markets. We have permanent team members in these markets. So it's a combination of both. For us, international business is doing really well. We are about 1.5 to 1.6x of our pre-COVID high numbers. In fact, last quarter was our highest ever. We are close to about 5% of total revenue in our international business. I'll request Dr. Ajay to take your question on Proton and everything else.
Yeah, in terms of Proton, as you know, Proton has been around since 1970s. And it is mainly because the efficiency was precision with Bragg Creek, and a lot of issues that are in the maintenance of Proton, apart from the cost and other things. There is no exit and entry dose. But as the time has advanced, now we have some units which are better than Proton. In fact, HCG considered Proton a few years ago. And I myself, being an oncologist and radiation oncologist, I was looking at it. But after careful evaluation and looking at the global usage of Proton, why it is coming down, attending the conferences and all, primarily because alternatives had come. And one of the things we have installed in Bangalore, of course, we have two CyberKnife, which is precision medicine radio surgery, one in Bangalore, one in Mumbai, and doing extremely well in terms of precision. And retreatment also can be done with literally very little exit dose. Now, advancement on this has been the ethos, which is adaptive radiotherapy, using the model of AI-based. And this has been a game changer for us. We have recently installed it. We have done significant number of patients in the 3 months. And what we are seeing, in fact, I am involved in partially in the research with Drs. Manjeet and Kritika. What we are seeing is as the tumor changes, day to day, we can make the change in the tumor geography and also change the treatment. And we are also studying what is the exact dose required. So this is a study in progress called radiosensitivity index. So with this kind of major developments, technology obviously becomes very important. Added to that, we are looking at how do we connect genomics to technology, where certain tumors respond well, certain tumors do not respond, why, and what is the genomic story behind it, so we can decide on the proper dosing of not only radiation, but also targeted therapy, immunotherapy, everything. Today, cancer treatment, as you may know, is multidisciplinary, and our outcomes based on this has been very good, very encouraging, not only in early stages, but even in advanced stages. Today, a lung cancer patient can live for, even with advanced disease, 8 to 10 years. A patient with breast cancer similarly can live for 8 to 10 years. So a lot of changes have taken place. Technology is going to complement, AI is going to complement the way we treat, and that is why in HCG we have become, really progressive on it. We are spending significant of money also on this to see how this can translate to precision patient therapy. You are absolutely right in terms of technology going to play a very big complementary role for doctors to see what should be the right treatment for the patient at the right time. I always believe first time right treatment will give us the best prognosis, and this obviously technology
virtual tumor boards are going to be big factors in future, along with AI, of course, as we go forward. Okay?
Got it. That answers my question. Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference over to Mr. Raj Gore for closing comments.
Yeah, thank you everyone for joining the call and all those your interest in HCG. Hope we've been able to address all your queries. We'll continue to keep you updated on regular basis on developments in HCG. For any further information, please get in touch with us or Strategic Growth Advisors or Investor Relation Advisors. Thank you once again and have a good evening.
Thank you. Ladies and gentlemen, on behalf of Healthcare Global Enterprises Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.